Well, bear market, bull market, doesn't matter. If you are a movie buff, what you want to do is watch movies. And I think that's what investors are betting on, because Inox Leisure, in a otherwise very choppy market, is sitting almost at a fresh 52-week high. 300 rupees for Inox. Raymond is making a comeback. Alpha Geo is making a comeback. Tata Global Beverages. Well, think about it. Market crash, and do you stop drinking your tea? You don't. So that's the reason why the Tata Global Beverages is also going higher. The bottom line here is that market corrections, they come and go. And if you look at equity as an asset class, if you're a genuine long-term investor, you will be able to ride this so-called mini sell-off as well. After such a big rise, if there is such a small sell-off, we should be embracing the fall rather than, getting into this doomsday theory of all is over for the bull market. But Dhirendra Kumar now joins us, and let's get his wisdom and advice as to what should investors do. And Dhirendra, for the first time, we are staring at a situation where there is an inflation scare after a gap of many years. Bond yields are at 7.5 or 7.5%. So do you think rather than starting with equities today for a change, we should start with debt, and that is where that is where the real opportunity now is?
No, I don't think individual investors should be opportunistic. They should be guided by their goals, because if you are investing for the long run, equity still remains. Of course, every portfolio, howsoever long term it be, justifies a small part being allocated to fixed income always for a variety of reasons. Of course, your emergency fund and the money that you need within the next 5 years in a very predictable or a non-negotiable goal should be in fixed income. That goes without saying, irrespective of where the bond yield is, because you definitely want to have the money when you need it, and it should not be dependent on the market. But besides that, your long-term portfolio should have a fixed income allocation depending on your own comfort level. So, as I keep suggesting that long-term investors should be investing in balanced fund, that actually amounts to having a 35% allocation to fixed income. Of course, the near-term outlook, bond yields are going up. This could enhance the return over time, but it can also translate into short-term losses for fixed income investors. But you should take a measured view of this thing, and the old saying that bonds are for gentlemen, and everybody should be a gentleman when it comes to your long-term goal-oriented investments. So everybody should have that fixed income, and I think don't be guided by those by the yields today. I think most long-term oriented equity fund which allocate the fixed income in their portfolios are generally relatively higher yielding bonds, corporate bonds. They dominate those portfolios.
Years ago, if I would have asked you that what is a better scheme or better asset allocation, you would have said go for mid and small caps. But the story has changed, and you've been making this case that don't go for small and mid cap stocks, stick to large diversified schemes, stick to large cap. So after this so-called mini shakeout, I'm not using words like meltdown and crash, because this is not a crash or a meltdown. What should one do? Which way should one lean? Go back to mid caps which have corrected, or stick to large caps now where the margin of safety is greater and higher?
No, first I would like to correct you that even if you would have asked me 2 years back or 3 years back, I would have not suggested any person to get started with small and mid cap fund. And even if I would have suggested, I would have suggested that let it be 10%, 15% allocation of your overall equity, because that is how it is. It's a different animal, and unless somebody has been through it, two things are very important for anybody to be in small and mid cap stocks or funds. You should have had the experience, and if you have been through a full market cycle, which means an experience of 5 to 7 years, and you have seen the ups and downs, because without real experience of markets on a free fall and these being on a freer fall, if you haven't witnessed 2008 and a 80% decline in the small cap funds value, you really can't withstand that. And to profit from those funds, you have to stick through these bad times. And this, what we have seen in the last 7 sessions is not necessarily the worst of times. We have of course small and mid caps have struggled for a relatively longer period, but I would always suggest that if you're a full if you're allocating 100% to equity, go with the multi caps, give the discretion to the fund manager, not even large cap, because there are times when there are prolonged period when the large caps can be out of favor and you will just watch it not perform. When you take the full advantage of an active fund manager. Give him the choice, give him the discretion, he can tilt the portfolio, and that is the way to go. First time investors should go with balanced fund, and so in fact multi-cap funds and balanced fund actually serve the need, or a tax saving fund if you are a taxpayer, and most of those funds are also multi-caps. You look at the numbers, you will actually find them getting aligned to the multi-cap performance numbers over a long period of time. So I would say that these three kind of funds actually fulfill the needs of most fund investors who are going to do their SIP, or even once in a while make a lump sum investment, or do their fixed income investment and move their money gradually to equity.
Dhirendra, then help our viewers with some of the large cap funds where you think one can look at entering in or investing in post this market fall.
I made a list of my best recommendations at the start of the year, and I would like to just share the same list, because not much has changed since then. And this kind of market fall, so my selection among the large cap fund was ICICI Prudential Focused Blue Chip, Motilal Oswal Focused 25, Mirae Asset India Opportunity, and SBI Blue Chip, and they continue to remain the best. Of course there are other funds also which are quite impressive, but if I have to choose some, these four looks most impressive. And large cap funds, the period can be challenging because your investment universe is very tightly defined. Your investment universe doesn't go beyond 80 stocks, and within that, to avoid the the relatively non-performer, ensure of course liquidity is not an issue, and to beat the benchmark and beat the total return benchmark today will be quite challenging. So selectivity and focus will be crucial, and these funds show the look promising.
Right. The other highlight which I keep reminding our viewers is how to balance their risk in this market, especially when volatility picks up. And the best defense to that is balanced funds. Any top of the mind, high rewarding balanced funds that you would recommend to our viewers this morning?
No, the whole idea of balanced fund is that you are not looking at the best of rewards, but I feel that in the coming times, if we are going to see this kind of turbulence, a period of 5% decline and 5% gains in a brief period of time, balanced funds will actually beat the large cap funds, or even sometimes multi cap fund. But the whole idea of balanced fund is that you are taking a steady take on growth with reasonable stability. Look at this last 7 sessions. Equity funds, the large cap funds are down 5%, multi caps are down 6%, and close to over 6% the small caps, and balanced funds are down 3%. So that's the deal. They are not on a free fall when markets crumble, and so that is you should definitely have the same long term orientation, should be investing regularly. My selection at the start of year, which continues to remain the same even now, is Aditya Birla Sun Life Balanced 95, HDFC Balanced, ICICI Prudential Balanced Advantage Balanced, and Tata Balanced Fund. The 4 funds, they show the most resilience and maintain the discipline of active rebalancing very often, and that does the job.
Should be a broader approach towards balanced funds, Dhirendra. Stick to 1 or 2 large balanced funds, or pick any one single balanced fund and you will be taken care of.
Yeah, over a period of time, if you are investing for 5 years, if you choose a reasonable balanced fund, the difference will not be much, and even if there is a difference, it is very hard to anticipate that. I would say that strike a balance of convenience and your scale. If you are investing 50,000 rupees, maybe consider investing in 4 of them, 50,000 rupees a month. If you are investing just 5,000 rupees, it will just not be worth your while. Too much of paperwork, 4 transactions, multiple transactions to reconcile with your bank account. Just choose one, and I don't think the difference will be substantial and hard to anticipate which one. But these 4 funds, choose any or 2 or 4, depending on your convenience and your ability to manage the complexity of paperwork and more transactions.
So Dhirendra, just to summarize today's interaction, and I'm sure this would be a key takeaway for investors and for genuine savers. Your view is that go for balanced fund right now, looking at risk versus levels. Don't go for small and mid cap funds, but if you go for balanced fund, you get an interesting mix of debt and equity, and that should be the broader proposition in the current environment.
Yeah. Yes. My first suggestion is that keep calm and carry on. Don't panic, because this is the noise created by the free fall, the big decline, and people watching, and they see 4% decline in the morning of the investment values that they have accumulated over a time. It is quite unnerving, and it doesn't matter. In fact, it will be interesting if you are able to over a course of time demonstrate that if somebody invested at the peak of 2007 or your balances, and 5-7 years from there on, it has still translated, we are 10 years away from the big meltdown of 2008, and some of these portfolios have translated into have delivered a return of over 15% through this period. So worst of times we have seen, and we are still better off. So look at have your expectation in line with the investment time frame that you have, and day-to-day basis watching it very closely can be very disappointing. And these three things, I think they are likely to be my by my approach to investing for every individual investor. If you are a taxpayer, invest in a tax saving fund. If you are not a taxpayer and investing your money for the long run, choose a balanced fund. And if you have had the experience of being through a full market cycle or reasonable 5-year time frame, you have seen the ups and downs, then go for a multi-cap fund. The small cap and mid cap, which looks very promising, and over a long period of time, 10-year, 15-year, 20-year, they will definitely deliver superior return, but they are not meant for everybody. If you don't have that temperament, keep away, otherwise you will be deprived of all the equity returns which investors can benefit from.
Fantastic to have you back. Thank you for your valuable advice. So don't worry, keep going, and that's that is the that is the very basic and a very important advice coming from Dhirendra Kumar, that if you are a genuine long-term SIP investor, don't panic. Take a deep breath and don't focus too much on the correction, because if you are an investor, if stock prices have come down, what you wanted to buy at 100 rupees today is available at 90 rupees, which means your investment is getting you more units. That's my simple message as well, that I don't think best of the bull market is behind us, and these panics, they only create opportunity because suddenly you're getting more bang for your buck. Very simple economics, isn't it?